Hi, today we're going to talk about top 3 dividend ETFs. So why ETFs? Why dividend ETFs? ETFs are considered much safer than holding individual stocks, especially if you're not very good at picking stocks. And when you compare dividend ETF with other types of ETF, dividend ETFs offer a lower volatility, meaning its price fluctuation will be smaller, and it also gives you dividend income, typically on a quarterly basis, and sometimes also on a monthly basis. Now let's look at this natural gas ETF. This is a commodity ETF. As you can see, over the past 1 year, this ETF actually dropped by more than 80%. If you go back in time, and you can see that from the year 2019 to 2020, this natural gas ETF actually dropped more than 80% as well. This price fluctuation is huge. Unless you have a very strong heart, I think it's very difficult to handle this kind of volatility. Now let's look at another type of ETF, which is a region-specific ETF. In this case, it's a China Small Mid Cap Index ETF. As you can see that the price fluctuation is also very big. From the year 2019 all the way to 2021, this ETF actually went up by more than 100%. But in the past 2 years, it erased all its gains and dropped by more than 60%. So dividend ETFs are considered much safer than some of these ETFs, such as commodity ETFs and emerging markets ETFs. So the first one is VIG. VIG stands for Vanguard Dividend Appreciation Index Fund ETF. Now let's look at VIG. VIG is given a gold medal by Morningstar and it has a 3-star rating. The highest is 5 stars and it has a total assets of 88 billion and its expense ratio is 0.06%, which is very low, and that's good. And its trailing 12 months dividend yield is 1.86%. This is actually quite low if you're looking for high yield, because if you put your money in money market fund, you can actually get as high as 5% for a year. So compared to that, this dividend yield is actually quite low. Now let's look at its VIG's performance and compare it with the market index SP 500 as well as its peers. This red line is market index and this blue line is VIG, and this yellow line is actually category. So it's this ETF category, and as you can see that for its category, VIG is actually better than average, but it underperforms the market index. And in terms of yearly performance comparison, you can see for the past 10 years, actually 8 out of the past 10 years, VIG actually underperformed the market index, which is S&P 500 index. Only in 2 years, 2018 and 2022, it outperformed the market index. As you can see that in 2022, VIG actually dropped less than 10%, but S&P 500 dropped by almost 20%. So VIG will give you better returns when the market is going down. Now let's look at its portfolio and its, first of all, its sector exposure. As you can see that it has the highest exposure to the technology sector, and followed by financial services, and then followed by healthcare and industrials. And what I like about its portfolio is that almost 87% of its stocks actually have a MO. So a wide MO rating actually means that the company is more likely than not to sustain its competitive advantage for at least the next 20 years. While a narrow mode rating means that this company is more likely than not to sustain its competitive advantage for at least 10 years. As you can see that over 90% of the companies that it invests in either has a wide moat or a narrow moat. Now let's look at its equity holdings. As you can see that it actually has 315 stocks in its portfolio and 32% of its assets in its top 10 holdings. So this is the top 10 holdings. As you can see, Microsoft, Apple, JP Morgan, Broadcom, United Health, Visa, ExxonMobil, Johnson & Johnson, MasterCard, and P&G. And most of the companies have very wide moat. Now let's look at the performance comparison between VIG and SPY. As you can see, this is the past 1 year performance. This is the past 2 years. You can see that in 2022, VIG actually outperformed SPY. Then this is the past 5 years. You can see that over the past 5 years, SPY outperformed VIG. As you can see that actually VIG over the past 16 years, it underperformed SPY by about 30%. But if you look at some specific time period, for example, 2029 all the way to 2015, VIG actually outperformed SPY. And 2018 to 2019, VIG again outperformed SPY. And during 2022, VIG again outperformed SPY. My number 2 dividend ETF is SCHD. Now let's look at SCHD. It has a gold medal by Morningstar and it has 5-star rating, which is the highest, and it has a total assets of 53.5 billion and its expense ratio is 0.06%, which is the same as VIG, and its trailing 12 months dividend yield is 3.49%, which is higher than VIG's 1.8%. Now let's look at its performance against the market index as well as its category. The blue line is SCHD and the red line is the market index and the yellow line is the category. As you can see that SCHD actually outperformed the market index, which is S&P 500, and it also outperformed its category. Now let's look at the total returns for each year for the past 10 years. For 2024, it actually has a similar return as the S&P 500. For 2025, it did slightly better. 2026, it underperformed the market index. And 2027, it outperformed the market index. And 2018, it again outperformed the market index. And 2019, it underperformed slightly. And 2020, it actually outperformed the market index by almost 10 percentage points. And 2021, it again outperformed the market index by 3 percentage points. And 2022, it outperformed again by about 3%. And 2023, it underperformed the market index by about 10%. Now let's look at its portfolio. As you can see that 99.5% of its funds are invested in US stocks. And its sector exposure, you can see that its highest sector exposure is healthcare, followed by industrials and financial services. And technology sector, it has relatively lower exposure compared to VIG. And you can see that only 61% of the companies that it invests in has a wide moat, and 25% of the companies that it invests in has a narrow moat. VIG, I like VIG's metrics better in terms of wide moat coverage and narrow moat coverage. And now let's look at the portfolio holdings. You can see that it has 100 stocks in its portfolio compared to about more than 300 stocks in VIG's portfolio, and 42% of its assets is in top 10 holdings. For VIG, I think it's only about 30% of its assets in top 10 holdings. Now let's look at its top 10 holdings. As you can see that it has Broadcom, AbbVie, Merck, the Home Depot, Texas Instruments, Verizon Communications, Chevron, Amgen, Coca-Cola, and Pepsi. In its top 10 holdings, I only find 2 technology stocks, and all the Magnificent 7, which did so well in 2023, are missing in its top 10 holdings. Let's compare SHD with SPY. Over the past 12 years, SCHD actually underperformed the SPY by more than 50%. So if you are actually a long-term investor, investing in SPY is actually still a better option. And if you will look at specific time periods, you can see that for the past 5 years, during the market crash, actually SCHD actually did better than SPY. But for the past year, you can see that SCHD actually significantly lagged behind SPY by a very large margin. Number 3, DGRW, Wisdom Tree US Quality Dividend Growth ETF. Now let's look at Wisdom Tree US Quality Dividend Growth ETF. It's given a gold medal by Morningstar, and it has a 5-star rating, which is the highest. And it has a total assets of $12.2 billion. It's a much smaller size compared to VIG and SCHD. And it has an expense ratio of 0.28%, which is much higher compared to VIG and SCHD's expense ratio of 0.06%. And its trailing 12 months dividend yield is only 1.72%. This is even lower than VIG's dividend yield. And now let's look at the performance of DGRW versus the index and its category. As you can see that it actually outperformed the market index, or it's performed as well as the market index, and it outperformed its category. Now let's look at the yearly performance comparison between DGRW and the index. As you can see that 2014 actually did as well as the market index, and 2015 it actually underperformed the market index. 2016 it outperformed a little bit, and 2017 it outperformed by more than 5%, and 2018 it actually underperformed the market index by about 1%, and 2019 it again underperformed by about 2%. And 2020, it actually underperformed the market index by about 8%. 2021, it actually underperformed again by about 2%. And in 2022, it actually outperformed the market index, which is S&P 500, by about 13%. That's when market crashed in 2022. And in 2023, it underperformed the market index by about 8%. Now let's look at its portfolio holdings and its sector exposure. As you can see that it invests 100% in US equities, and it has the largest exposure to technology sector, followed by healthcare, and then industrials. 30% exposure to technology sector, which is very high, is higher than VIG and SCHD. And you can see that it has close to 300 stocks in its portfolio, and its top 10 holdings account to almost 40% of its assets. Actually, this is quite concentrated. As you can see that Microsoft actually accounts for more than almost 8% of its entire portfolio. And its other top 10 holdings include AbbVie, Broadcom, Johnson & Johnson, the Home Depot, P&G, and Nvidia, Coca-Cola, and Pepsi. And you can see that all the top 10 holdings, these top 10 holdings have a wide economic mode. And this is what I like. But what I don't like is it's just too concentrated. It has almost 40% of its assets in top 10 holdings and is heavily invested in technology sector. Now let's compare DGRW with SPY. As you can see that for the past 10 years, you can see that actually it outperformed SPY by about 1%. Let's see some other time periods. Let's see the past 5 years. The past 5 years, during the bull market in 2021, SPY actually outperformed DGRW. And then in 2020, DGRW actually outperformed, did better than SPY. So if I'm a long-term investor whose holding period is 10 years and beyond, SPY is still the best. But if I'm not investing for the long term and prefer dividend income and relatively lower volatility, then dividend ETFs is a good choice. But there is no need to buy multiple dividend ETFs at the same time because there is quite a bit of overlap in their stock portfolios. So when the market goes up, all the dividend ETFs will go up. When the market crash, all the dividend ETFs will crash. So there is no point to hold multiple dividend ETFs.